To be a value investor is to pay less than the business is ultimately worth. I have learned so much. I think I've made every mistake there is. I've learned on the job in the last 23 years. As long as clients are always a lodestar, then decisions become easy.
Sarah Ketterer buys stocks for a living, but she has no interest in buying NVIDIA.
No, because so much growth is already embedded in the valuation.
That's because Ketterer is a so-called value investor. Her $50 billion firm, Causeway Capital Management, focuses on researching stocks with prices lower than their intrinsic worth.
To be a value investor is to pay less than the business is ultimately worth. And we give every company about 2 years to show us what it can be worth, and then we assess what that price should be 2 years from now. And if the price 2 years from now should be considerably higher than it is today, the stock is likely undervalued.
Ketterer comes from a long line of Californians. Her father, John Hotchkiss, was a commissioner of the 1984 Los Angeles Olympics. He was also a well-known value investor and had his own firm, Hotchkiss & Wiley. After getting her undergraduate degree at Stanford and her MBA at Dartmouth, Ketterer did a brief stint in investment banking in New York City before moving back to the West Coast and joining the family business.
I had started a database business, so I rang up my father and his business partner, George Wiley, and said, "Do you need any data?" And I'm not sure they did, but they were very kind and said, "Well, bring it out here to Los Angeles and we'll talk." That's
where she met Harry Hartford, with whom she would go on to found Causeway in 2001. They had $7.5 million when they opened their doors. Today, their 100-person staff manages $50 billion in assets.
Timing is everything, and we launched Causeway after the telecommunications, media, and technology bubble burst. So this was 2001, and value investing was coming back. The style was coming back into favor.
And Ketterer doesn't seem to be slowing down anytime soon.
I'd like my legacy to be even greater employment. I want to employ more people who are in, as I talked about, that great career trajectory. I'd like to have more clients who say, "We really appreciate the service you're providing us."
Explain to me what makes Causeway so distinctive. Why is it different than other money management firms? There's plenty of money management firms out there. Why is yours different?
Well, Causeway has, from our beginning in 2001, believed in the combination of fundamental and quantitative investing. And there are two different ways of doing investment research in the world of long-only equities. But you put the two together and you get something that's better than just that narrow, sort of very discretionary, subjective viewpoint, and then something better than the statistical absolutely.
What do you call that? Is it called quant value or value quant? Or
yeah,
what
depends who I'm talking to. To the quants, I say it's quantamental. To the fundamental people, I say it's fundamental and quant.
So you're what's known in the business as a long-only fund, right?
We are long only.
And you're known as a value investor. What does it mean to be a value investor?
That is the $100 million question, because everybody defines it differently. We define it as for portfolios where we use a fundamental approach, so that's the analysis of financial statements, the interviews of company management, the assessment of the industry. To be a value investor is to pay less than the business is ultimately worth. And we give every company about 2 years to show us what it can be worth, and then we assess what that price should be 2 years from now. And if the price 2 years from now should be considerably higher than it is today, the stock is likely undervalued.
Now, the late Charlie Munger said that he changed Warren Buffett's views on value investing. Initially, value investing in Warren Buffett's view was buying something really cheap, even if the company wasn't great, but it's cheap. And Munger said, no, buy good companies, even if it's a little more expensive, as long as it's not overly expensive. And Warren Buffett allegedly began to do that. So what do? Do you buy really not great companies, but they're cheap? Or do you buy good companies that are a little more expensive and call that value investing?
Those two, and late Charlie Munger could simplify the most complicated of situations, but in a way it's neither. They may be in good businesses, they may have very few competitors, they may be in oligopolies, or they may be in an industry that's rapidly growing. There could be reasons why you call them good, but something may stop that. They may have a lawsuit levied on them, or they may have a scandal, or they may have a poor CEO who does a poor job of executing, and then they become bad. And that's when we like them. So if they're good in most markets, they'll be priced for good.
So suppose somebody came to you and said, I have a good stock, it's growing a lot, and it's called NVIDIA, and is that a value investment? Do you think that's a good value investment?
No, because so much growth is already embedded in the valuation. So if NVIDIA is in the building part of the technology cycle, then there's the delivery part, and then there's finally this where we put it all together and AI is ever present. In that last segment, enterprises, businesses will need to use AI, and they have no idea how to, many of them. So you could go out and find, for example, in info technology, or technology services companies, this Accenture or Capgemini or some of the Leviathans. But as you move down the market cap spectrum, like Cognizant or Fujitsu in Japan, or Concentrix or Genpact, these companies are going to be advising their enterprise clients on how to deal with this. Once all the infrastructure is built, once enterprises have moved everything they have to the cloud and they're ready to go. So there's value in this whole concept. The theme that's driving NVIDIA has unearthed a whole raft of stocks that nobody cares about today, but they will in the future.
So you do some international investing and emerging market investment. So it seems like it's an oxymoron to say I'm a value investor in emerging markets, because emerging markets are very volatile. So explain how you can be a value investor in an emerging market. I
did want to add, we also manage money globally, so we have global equities. But I think investing in a number of areas could be an oxymoron. The emerging markets, the single largest country in the emerging market index is China. And it has gone from being a powerhouse of growth to slowing considerably. The Chinese property market is weak, dragging the economy. The population's aging, which is also creating cost. So emerging markets is a blend of fast-growing India and slower-growing China. But there's always value. And we approach emerging markets with a quantitative investment research style, and that allows us to use both value and some growth, as well as other factors to identify outperforming stocks. The theory of emerging market investing is that the rate of return will be higher because there's less competition, prices are lower, et cetera. But that theory has not been proven yet, has it? In other words, the rate of return, risk adjusted, for emerging markets investment is not that much better than developed market, is it? Again, talking about a broad index, I totally agree with you. It hasn't been better. It had its run in the early part of the 2000s and right through the global financial crisis, but ever since we became much more financially accommodative in the developed world, and central bank balance sheets expanded and financial conditions became very loose, emerging markets then had their own issues. I think that China really crested in 2021, which was the leading market in emerging markets, and now is suffering under the cloud of potential overregulation and Communist Party rule. So today, when you're making investments, you've got about 130 people in your firm, something like 107.
that? 107. Okay. So do they come to you for every decision? Do you have to say, yes, buy this stock or not buy this stock? Or do you have a delegation of approach where you don't have to approve every investment? We have a very dispersed decision making, and that was deliberate. When my co-founder, Harry Hartford, and I set up Causeway, just in our minds long before we actually launched the firm, we didn't want to have a star system. We didn't want our investment results to depend on any one or two people, no matter what the strategy was, because there's too much business risk doing that. It's risky for clients, and it's risky for the firm itself. All right, suppose I say, I've heard about your company, I'd like to give it a chance. What kind of rate of return would I expect I could get? I mean, you're doing emerging market and international and also domestic long-only equity investments. Is that a 7% rate of return business, 9%, 10%, 12%? What do you think it is in an era of 4 or 5% inflation? Yeah. Well,
I think the 4 to 5% inflation might be more emerging markets. Otherwise, we're all in serious trouble in the developed world. But let's just take a 4 to 5% 10-year government bond yield, or maybe 4 might be more reasonable, and add an equity risk premium. So that the premium is for taking the risk of buying long-only stocks, publicly traded equities. How much more should the investor be paid? That's probably 3 or 4 percentage, maybe 4 percentage points more. So maybe out of public equities anywhere in the world, if the risk-free rate is somewhere around 4, you should expect 8, maybe 9% per year from your equities. But that's just the index, and you pay us as the active manager to do better than that.
Well, let me ask you about that. There's a theory that you can't beat the markets. So some people have propagated the idea that the best thing to do with your money, if you're going to be in equities, is just buy an index fund, tiny little fee, and you are the market. Whatever the S&P 500 is, or the Dow, whatever the Dow is, you're going to be that. Your theory is that you can beat the markets. And have you been able to beat the markets for the years that you've started the company, about 20 years ago?
Yeah, it's been 23 years, and we don't beat our indices. So international has an international market index, emerging has an emerging index, global has the global index. And we don't beat it every year. I don't think we could, given our investment style isn't in favor every year. But we beat it over market cycles. Markets rise and fall. We call a full market cycle. We outperform these benchmarks.
So as I look at opportunities now that might be available for a long-only investor in the United States and or around the world, what are some of the opportunities generically that you think are attractive? Not necessarily companies, but opportunities generically.
The entire non-U.S. region has been second-class citizen versus the extraordinary U.S. market. And think about non-U.S. developed as a value stock. The income, just on average, from stocks listed in Europe and even parts of Japan, not just the dividend income, but the buybacks far exceed that of the U.S. So I just can't tell you, when eyes just keep moving to the U.S. market and get concentrated in few stocks, that leads to a great opportunity for investors to find mismanagement or situations where companies just need a nudge from institutional investors like Causeway to get them to improve their outcomes. We went out and found external capital because I couldn't get any money out of my family, none, not even a penny. So that was another good luck, you're on your own, kid.
Let's talk about the beginning of your life and then how you came to start Causeway. So where were you born?
Pasadena, California.
Okay, and your father is a very famous investor. He was a very famous value investor, is that fair?
It's fair.
And he started some companies that were well known in the investment world.
He did.
So did he say, I want my little girl to grow up to be an investor?
No, I went into undergraduate as a pre-med, so I had no idea that finance was in my future.
And what happened?
But
You
I
didn't
took
like
economics.
biology or chemistry?
Yeah,
or what
no,
happened?
I did. It wasn't just spinning out of organic chemistry, it was taking economics.
Oh.
Yeah, I had the most extraordinary professor, Michael Boskin, who at the time was the...
Well, he became the head of Council of Economic Advisors under President Bush.
Exactly, and that was éclat, like, this is for me.
So you told your father, you're not going to medical school, you're going to be an investor. He said, what?
He said, just finish college, please, and then we'll talk. But I went into investment banking, and that turned out, at least from my perspective, to be a poor fit for my skill set, too transactional. And I was really interested in something where I could dive in and spend a lot of time thinking about underlying companies.
So after you graduated from Stanford, did you do some investment banking for a while? Or?
I did corporate finance for 2 years at a firm called Dean Witter, which is long gone, hard to find.
And then you go to business school afterwards? Or?
I did, afterwards.
And you went to Tuck at Dartmouth?
Mm-hmm.
Well, I mean, Tuck's a great school. It's a wonderful school. Dartmouth is wonderful, but it's a long way from California. So how come you went all the way east?
I only applied to East Coast graduate schools because I needed to get out of California. It was just part of California is wonderful, but it can be a little insular, and There was so much more to learn.
When you graduated, did you say, I'm going back to California, or what did you do then?
No, I took my first job here in New York City for another firm that doesn't exist any longer, Bankers Trust Company.
So when did you say, I'm going to start my own firm? I'm as good as some of these other people.
Well, I started a database business, recognizing that I had some non-U.S. transactions I was working on, and the data was scarce. It was hard to get information on non-U.S. companies that was as good as you could find for U.S. So I left and founded one, and then I needed customers. So I rang up my father and his business partner, George Wiley, and said, do you need any data? And I'm not sure they did, but they were very kind and said, well, bring it out here to Los Angeles and we'll talk.
Well, your father started a firm with his partner, Hotchkiss and Wiley. Your father was
John Hotchkiss, yes.
And then he ultimately sold that firm to
Merrill Lynch.
Merrill Lynch. And then were you at the firm when he sold it?
I was.
And then he said, well, now the firm is sold, you can stay or you can go. What did he say?
He said, good luck.
Good luck.
Yeah, that's right. He was on an earn-out, so he was being paid over time, over the next several years, for his ownership stake. And I went on an employment contract. But when my employment contract ended, that nobody renewed it. So knowing that I was a free bird, I started to plan this idea of Causeway. That was the
Where did the name
of it.
Causeway come from?
My business partner, Harry Hartford, he's Irish, and it comes from the Giant's Causeway, which is this 50-million-year-old array of basalt columns in Northern Ireland that leads out to the Outer Hebrides.
Who was your partner?
My partner, Harry Hartford, he came from the Bank of Ireland. I met him on the phone in 1994. It was like a wicked storm. I mean, the weather was so bad where he lived in Dublin. And I said, you'll like it in Los Angeles.
So you started the firm with any money? How much money did you have to get started?
We had all what Harry and I had saved. Our COO, who remains our COO today, Gracie Familia, another woman in leadership at Causeway, she pitched in. We went out and found external capital because I couldn't get any money out of my family, none, not even a penny. So that was another good luck, you're on your own, kid. And
okay. All right, so you went out and raised, how much money did you have when you started, opened the doors?
We opened with $7.5 million.
$7.5 million?
Yeah.
Okay.
We had 24 people, and we lost money for 3 years. So we had external capital who took 20% of the business, and they were anxious.
But now you have 50 billion.
Yes.
So how did you go from $7.5 million to 50 billion? Yeah. Was it, you must have had a good rate of return, so what enabled you to grow the firm?
Largely, we had just built an incredible team. It's always about the people, especially in asset management.
So you would go out and raise the money? Was that part of your job, to raise the money?
Initially it was. I took a lot of red eyes. I had 3 young kids at home, and I was on airplanes constantly.
So you're out raising the money, and you're telling people your track record's good, and then were you surprised it went sort of much like this in terms of raising money? You've got a fair amount of money. 50 billion under management's not bad.
Yeah, timing is everything, and we launched Causeway after the telecommunications, media, and technology bubble burst. So this was 2001, and value investing was coming back. The style was coming back into favor. So we had the wind at our backs. We had so many clients who were under-indexed to value and wanted value and were interested in non-U.S.
Now, in 07, 08, there was a gigantic financial crisis in the
Yes.
United States, known by some, or to some, as the Great Recession. What happened to your business then?
Our assets under management halved, so we shrunk precipitously. And at the time, Harry Hartford and I had taken out loans to buy out our seed investor. So it was perilous, and it was really nerve-wracking. It was one of many, what I'd call, significant bumps in the road along the way to 50 billion.
Who owns the firm now?
We are 100% employee-owned, and one board member who's a former portfolio manager who's retired.
What is the biggest challenge you have? Is it getting more money, getting sure the returns are good, figuring out what's going on in the geopolitical situation? What is the biggest challenge you have today?
It's always retaining the talent, making sure that the people we have, think about, at least in our business, it's just layers of succession. There's the senior generation I'm a part of, and there's the generation beneath that, and the one beneath that, and ensuring every individual, no matter the area of Causeway in which he or she works, is on a path a career path that's satisfying and one where that individual will continue to contribute and is motivated. Times have changed and they've improved, but in the 80s and the 90s, it wasn't easy being a woman in finance. Lots of closed doors, but no longer.
So do you get tired of people asking you what it's like to be a woman-owned firm and a woman CEO in the money management area? I assume you get tired of that, but what is your non-tired answer to that question?
Times have changed and they've improved. We have a pipeline of incredibly talented young women coming into research that never, even 10 years ago, didn't exist. So some of them call me a pioneer, which makes me feel ancient, which they're absolutely right. But in the 80s and the 90s, it wasn't easy being a woman in finance. Lots of closed doors, but no longer.
So what's the best investment advice you've ever received? I assume your father probably gave you some, or maybe Charlie Munger, or other people like that. What's the best investment advice you ever got?
Well, all my mentors were men, a mentor aptly named, and often it was, and these aphorisms are as good today as they were decades ago, which is, don't fall in love with your stocks. Remember, if you can just think beyond the market's short-term viewpoint, if you can be patient, you can see a reasonable return. Never neglect income. Like, I don't know if I could rank these. There are so many of them.
What do you think the most common mistake that investors make? Is it selling too soon or buying too soon? What's the most common mistake in your observation that investors typically make?
Well, even institutional investors who I think should know better, they project the present into the future. They extrapolate. So when an investment style with a great team like Causeway, where all the talent is intact, turns down, they panic. And when we do everything in our power to explain to them, as we would our mutual fund investors, this is a time when we're doubling down. We're buying more of these stocks that have underperformed because we have conviction in them. So you should think the same of us.
So if I come to you and say, I have $100,000, I don't know what to do with it, what would you recommend I do with $100,000? Let's suppose I'm a middle-class person, I've saved up some money, I've got $100,000, I don't want to lose it, but I'd like to get more than a Treasury bill rate of return. What should I do with my $100,000?
My answer would depend on when you want to retire. Do you have any major expenditures? You're going to put kids through school. So knowing when you need the money that determines, because if you need it sooner rather than later, equities can be volatile, and cash now pays 5+% in the US. That might be a place to put whatever you need in the next 2 years.
So let me ask you today, you look back on your career, do you think that you have fulfilled what you wanted to do, build your own money manager firm? What's your ambition now? You're still very young by my standards, so would you like to build it into a bigger company than you have, or do something different professionally? What is your professional goal now?
I'd like my legacy to be even greater employment. I want to employ more people who are in, as I talked about, that great career trajectory. I'd like to have more clients who say, we really appreciate the service you're providing us. And that's just going to take more time and effort. This idea of bringing more fundamental and quantitative investing together more closely to get a better outcome, there's just more work to do to get there.
So, but you still enjoy what you're doing.
Yes.
What have you learned about yourself as a leader? So you went into this company, started it about 20 years ago. You had not owned a company and run it one yourself. You'd been in money management. Now that you've been a leader for 20 years or so, what have you learned about yourself that you maybe surprised you?
I have learned so much. I think I've made every mistake there is. I've learned on the job in the last 23 years. But one of the biggest lessons that I've taken away is don't underestimate the need to collaborate. Even though I'm convinced I know the answer, bringing others along and making sure that they have bought in and they take ownership of the solution that I'd like to implement.